In this video, traders, we look at taking into account all the expenses in trading, the forgotten ones that we forget about. Stay tuned. Hey traders, a warm welcome to you. So Warren Buffett, I believe, mentioned something about these frictional expenses. These are little expenses that kind of come into a deal that you don't think about because you're wrapping up into the bigger picture, but they add up to a substantial amount of money over the long term. And that applies in trading. We tend to think, okay, well, I bought this at 100, I sold it at 120, great, there's my profit. But no, there are so many additional costs into that. That may well be your profit, but you may well have had to pay costs throughout all of there, which actually would result in a bigger profit if you hadn't had to pay the costs. Now, I get that you are using a facility, a broker, this, that, the other. There's plenty of people in the chain that require getting paid for you to do the deal that you want to deal when trading. I get that. But the point is, I'm not saying we should be trading for free and these guys should be doing stuff for free. Of course not. But I'm just saying, as a trader, we need to be aware of all of these when we're thinking about our trading setup and our trading strategy, and specifically our strategy in terms of, because some people are saying, okay, well, should I do scalping? Should I be doing long-term trading? Really, scalping shouldn't be on your list at all, unless for some real reason you've got a great feel for it and it's something that works well for you, because those frictional expenses all of a sudden add up to a massive percentage of the trade deal. But let's look at them and let's discuss that in a second. All right, so the first one's obviously the spreads. You need to use a broker that has a tight spread. Now, if we're talking about FX, if we're talking about spread betting, if we're talking about CFDs, that's going to be the deal you do with the broker. It's going to be the broker that you select is the size of the spreads. If you're trading direct in the exchange, if you're trading stocks, trading futures, you want to be trading something where the spread is reasonably narrow. Now, there's an offset to be had there. If your trading strategy applies better to less liquid instruments, of course, you're going to have to pay a bigger spread. Then perhaps you need to consider working orders on the bid, on the offer, hitting in the mid, that kind of stuff, rather than just using market orders. That will reduce that spread for you. Similarly, if you're trading FX, even though you can't specifically, let's trading against the broker or spread betting company or CFD company or spot, whatever it may be, you can't, of course, go in the order book and join the order book in the interbank market, but you can still use a limit. And you'll be surprised how many times you'll be hit on your limit. At the end of the day, when you use a market order, you're basically saying you don't expect that trade to take any heat whatsoever before it hits your target. That's really what you're saying. And in reality, that's not the case. So consider, or perhaps go back and look and say, well, if I'd used a limit order and just a limit order at the bid even, right? So let's say we've got a spread of 52 to 53, whatever that may be, whatever currency pair, rather than taking it at 53, putting a limit at 52, how many times would you have got filled on that for all your trades? My guess is probably a high percentage, and it wouldn't have negatively affected your returns and would have positively affected them because you're making an extra pip on every single deal that you do. And think how many trades you do. If you do a couple of hundred trades, a couple of hundred extra pips, thanks very much. Or whatever, you get the point. So spreads, people are aware of spreads, guys. We forget, and we kind of forget because conveniently, of course, when we're mark to market, we look in our blotter, it says we've gone long here at 53, we've exited at 153, great, we've made 100 pips, but we forget that actually we've paid the spread as well, because it's not marked on there. The spread could have been 45 to 53, we've paid a massive spread on that. Yes, our net profit is X, but we could have had more if we worked out the spread. Anyway, enough from that, I'm sure you get the point, guys. Right, overnight charges. Don't forget, same with the short borrow fees, same kind of thing, depends on what we're doing, of course, and who we're trading with. You mustn't forget those, because if we're trading on margin, we're going to be charged to hold positions overnight. So over that longer period of time, for holding swing trades with reasonable size over a long period of time, that can add up to be a hefty amount of money. Same with the short borrow fees. If you've got a strategy that works on heavily shorted stocks, normally those borrowing fees are higher. In some cases, guys, they're like 100% a year. Now, you've got to be almost, you've got to be, well, you know how right you've got to be absolutely perfect to go to zero so that's making any money for you, or it's got to move in very, very quickly, a large amount very, very quickly. So that's an extreme example, but you get the point. Keep an eye on those overnight charges and the short borrow fees. If you need to negotiate with a broker and you're holding a lot of positions overnight, then do so. If you need to maybe put more capital into the account so you're not trading so much on margin and you have that ability, then maybe consider doing that. You're still risking the same amount, but you're not borrowing it, so you shouldn't be paying those overnight charges. Not for the short borrow, but if you're trading on margin, that is. Okay, data fees. Now, You may well, we're way better now, guys. You know, the current environment we're in now, data so cheap. Charting is almost free. You can pay data fees to get your future stuff and this, that, the other if you need to, but no one's paying 800, 900 quid a month anymore for real-time charts. So that's better than it was, but still, be aware you're not paying for stuff you don't need. If you take one trade on crude oil futures a quarter and you're paying for a NYMEX data feed, it may only be a really relatively small amount, but why not do something different? Why not say, well, you know what, actually, I don't really need that. I don't really need to trade on that, or I don't really need to be monitoring crude oil all the time. Why don't I just use the delayed feed because I'm on a swing thing, or whatever. You get the point. There's no point. I see some people, and I've been guilty of this as well, to be honest with you, I've signed up for every single data feed. I've got this massive bill. And I'm like, 4 or 5 months in, you're thinking, why am I paying for every single exchange almost? I've got a ridiculous bill and I've not even traded these things. I'm actually going to be better off if I just get rid of half of it, just focus on the stuff I want to trade. And even, the stocks and stuff are so relatively cheap anyway, but something to keep an eye on. Commissions, the big one. So this was going to apply if you're trading CFDs. I know that the different brokers have different structures. Some just you pay the spread. Some you pay the spread and you pay a commission on top. If you're trading stocks, this is going to be useful to you for trading commissions. Maybe it's time to do a deal with a broker. It doesn't harm, even if you've got a small account, to ring up and say, hey, this is my account. Can we do a deal on commissions? It takes you 10 minutes, and the worst they'll say is, no, you know what, we can't do it. And then you can say, well, what sort of level would you do a deal at? And they say, well, if you're doing this amount of money, then we can do a deal. Then you know. Then you can either shop around or you face it and accept it. But from a trading strategy point of view, we don't want to be churning too much because it's going to add up to those frictional expenses adding up. Okay, taxes. Fortunately, we have a vehicle in the UK called spread betting, which means for the majority of people, the trade is tax-free. Different circumstances can apply, but for the majority, that's the case. So you don't have to pay tax on that. However, if you've got other things you're trading, for trading futures, trading CFDs, or other countries, etc., taxes do come into it. Now, does that mean that you should allow that to change your strategy? No, I don't think it does. There's a saying out there, isn't it, that you shouldn't let the tail wag the dog wag the tail, something like that. Someone could put it in the comment section below. But it's something about the tax, basically. You shouldn't consider the taxes too much when you're talking about your investment. Yes, you should think, okay, this is an expense I need to pay at some point. But being aware of things like, okay, there's certain stocks in the UK that if you want AIM, I don't know if it's still available now, but on AIM, if you're investing in stocks for a certain period of time, the capital gains gets staggered down. You have to do due diligence on that and check it out for yourself, but there may well be other things and wrappers you can put stuff into, different tax wrappers too, which really is just paperwork. It's just prudence and due diligence, saying, well, you know what, I may as well put this in this wrapper because I'm going to save a little bit of tax and I'm only doing a small amount of trading in it anyway. You get the point. So just some planning can save you an awful lot of money when it comes to taxes. By the way, there's no advice on taxes, guys. It's just being aware that it's expenses. You can't just say, oh, I've made this amount of money and forget that you're going to have to pay your tax on it. Right, performance fees. So this is more for your mutual funds and your funds that you're putting money in, like robo advisors or whatever it may be. Being aware that those fees can add up. If you think about over a long period of time, if you're putting money in and you're letting it chug away, can you replicate that performance without paying that fee? Something to consider. And the final thing is the FX exposure. I missed the X off that. FX exposure. What I mean by that. So it depends on the broker. For some brokers, if you're trading in a specific currency or if you're trading on a specific exchange, they will convert that, your native currency. So let's say GBP for me, they'll convert that into USD. I'll trade US dollar stocks directly on the exchange. And then it will leave the balance I've made in USD. And then I'll go and I'll trade on another exchange. Let's say I trade on the Canadian exchange, it will leave it in Canadian dollar. So I'll have USD, I'll have GBP, and I'll have Canadian dollar, and that'll all be in there. But then I'll have FX exposure, which I didn't want. Now I could convert that back to GBP after every trade. Of course, there's a bit of time with that, and also I'm paying spread. So don't forget about things like that. You've got to pay your spread on that. And also, unknowingly that you forget you've got this exposure. So not only have you got the spread, but also you're unwittingly, you shouldn't be unwitting, you should know, but you potentially got this exposure to other currencies that you didn't really want. You've got a trade on you didn't really want. So being aware of that, depending on the broker that you're using, depending on the situation you're trading, that may well be the case. Anyway guys, those are some kind of frictional expenses, and we have to take into account all the expenses. This is just a kind of video to make you think, okay, well, it's not just about going from A to B, it's about thinking what's the most cost-effective way of me doing it. And specifically, if you're thinking about a new strategy, you think about a new strategy, for example, I want to just have a short strategy, that's fine and that works, but don't forget those borrow fees can add up, the overnight charges can add up. If you're trading some illiquid instrument that's perhaps been pumped up aggressively, then the spreads are going to be higher. And we tend to forget that because all we're looking for is the chart, and we forget actually it's going to cost us a lot to get in that deal if we're using market orders. It's going to cost us a lot to borrow, and etc. So something to think about, guys, taking into account all your expenses when you're trading. Take care, whatever you're doing. Bye bye.